Hello everybody, this is Sabyasachi Paul from Eastern Financiers Limited. Today I wanted to discuss the different tax saving investment options which are available to you. Firstly, amongst all the different avenues that are there, I think one of the most important would be PPF or Public Provident Fund, which currently gives a return of around 7.1%. Now, this has a tenure of 15 years, which are extendable by blocks of 5 years. So, 15 years, you can extend it by another 5 years, 20, another 5 years, 25 years. So, this is basically tax free corpus for your retirement. And one unique thing about PPS is that uh, it falls under the EEE category, which is exempt. So your principal, your interest, as well as your uh, corpus, when you withdraw, would all be exempted from tax. Now, I think it is highly recommended that anybody who doesn't have employee provident fund, especially for sole proprietors, if you have business, or even if you are employed but you don't have employee provident fund, it's always advisable to have a public provident fund account with any bank or the post office. Now, coming the second one, I think employee provident fund or voluntary provident fund. Till some time back, it was giving about 8.65% kind of interest rates. So this was brought down to about 8.1% currently. But I think even then, this would be, one of the highest returns which are given in any of the small savings schemes. So this continues till retirement, and employee provident fund would basically be about 12% of your basic salary, which is deducted. And in the last budget, a provision was brought in wherein employee provident fund allocation in excess of rupees 2.5 lakhs in a year would be taxed. So up to 2.5 lakhs uh, provident fund in a year would be tax free. And I think whatever again voluntary provident fund, whatever employee provident fund that you would already be getting as 12% of your basic pay, if you want to deduct additional money and get 8.1% kind of returns, you can opt for voluntary provident fund. Coming next, I think would be Sukanya Samriddhi Yojna scheme, which is basically for the girl child. I think this is one of the uh, essentials, or it would be very important to have this scheme if you have a girl child. The government, again, a small savings scheme giving 7.4% returns. It has a tenure of 11 years to 21 years. 11 years because you can start off with this scheme with your daughter's age maximum 10 years, and this scheme matures when your daughter turns 21. So basically that's why the tenure is 11 years to 21 years. So coming next would be your National Savings Certificate NSC, which gives about 6.8% returns. This is basically for 5 years. You can do it through uh, post office. Various banks offer it. So 6.8% per annum. It is compounded half yearly but payable on maturity. Next, we come to ELSS or equity linked savings schemes, which are basically one type of mutual funds which give you tax benefits. So, this is entirely market linked. So, you could be getting Again, it is not fixed, so it could be getting anywhere between 10, 12 to maybe 14, 15% kind of returns. It's a lock-in of 3 years. Now, the only thing which I wanted to mention over here is that if we see the long-term trend for the Sensex, it's delivered somewhere between 14 to 16% annualized return on an average for the last 20-25 years. So I think, if you can be disciplined enough to invest in ELSS, to keeping in mind your retirement till you retire at 60, for a long time, it could be 10, 15, 20, 25 years. I think this would be one of the best products in terms of returns that you can get, or the kind of corpus that you can accumulate for your retirement, because of the kind of the returns over here will definitely be higher, and the longer that you hold on to it, the higher the returns. So coming next would be NPS, which is National Pension Scheme. Again, market linked, you could be getting anywhere between 8 to 10% kind of return, depending on what kind of corpus or what kind of schemes that you choose. This again is still retirement. Now, this is a very low cost retirement corpus with a slight equity mix uh, that would be there. So NPS basically provides you two types of accounts, Tier 1 and Tier 2. Now Tier 1 is mandatory retirement account, whereas Tier 2 is a voluntary savings account, which is in addition to the Tier 1 account that you have to maintain. So this basically gives you a a permanent retirement account number. Now, Tier 2 offers flexibility, as I was mentioning, in terms of withdrawal, unlike Tier 1 account. So, in Tier 2 account, you can withdraw your money at any point of time. So, in terms of options, in terms of schemes, now that there you know you there is an equity option, there's a corporate debt option, there's a government security option, and the mix of these three types of investments will depend on your age. uh, at a lower age, you would be having a higher mix of equity, and as you get older, the equity mix will keep coming down, and you would shift to corporate debt and government securities. Now, coming next, we have ULIPs and insurance plans. ULIPs would be market linked insurance plans, which would give you again anywhere between 8 to 10%. Uh, so, it is basically market linked returns with life cover. Endowment plans, as far as insurance is concerned, is again it would be giving you about 6 to 7% returns, and the investment tenure could be anywhere between 10 to 30 years. It is basically some kind of assured returns, some kind of bonus, fixed kind of returns with life cover. And a term plan in insurance would be a pure life cover without getting anything in return. So it would be zero coverage, but it would be a very low cost insurance cover with a very high coverage. So you would have to pay very little amount of money for a very higher coverage as far as insurance is concerned. But over here, I would just like to mention that although I have, come up with ULIPs and insurance, I personally feel that insurance is not investments. It is basically protection, and the intent should be protection, should be uh, keeping in mind your dependents, that if anything happens to you, your dependents should be secure financially. And so in terms of insurance, we should not mix up insurance with investments. Insurance should be kept separate, so it should not be considered as an investment for you. So you take a, as far as I'm concerned, you take a pure term plan with a very high coverage of say 1 crore, 2 crores, whatever permits as far as your income level is concerned. so that the kind of corpus that your dependents will get would be significant, so that they don't face any financial trouble. Okay, so lastly, in terms of the last instrument that I want to discuss would be bank fixed deposits, which give you about 5.5% to 6.5% kind of returns. Now they would be having a tenure of 5 years. Now these are guaranteed returns, but again, it would be significantly lower than what you would be getting as far as market linked policies are concerned, or even small savings schemes which are offered by the government. The only point over here is that if you're a senior citizen and you are investing in bank FDs for tax saving purpose, you would be getting about 0.5% extra returns or extra interest. But again, all said and done, I think amongst all the different schemes that are there, uh, bank FDs would be offering you the lowest returns, but again, guaranteed. Lastly, before I close, I would like to mention that all the small saving schemes that I mentioned, be it Provident Fund, EPF, Sukanya, Samriddhi, NSC. Now, these are all different small saving schemes offered by the government, and the government, revises some of these rates every 6 months. So, from time to time, they are revised up or revised down. So my sense is, again, going ahead, given at this point of time the way interest rates are being increased, we should see a positive revision in some of these rates, maybe 6 months down the line. So if you like what I am saying, what I share, then please subscribe and share my videos for better reach. Thank you.